So, analytical procedure, last time as I explained, is an analysis of relationship among both financial and non-financial information to determine their possible relationships. And last time I used ratio analysis as an example and trend analysis, where sometimes the auditor compute ratio analysis compared with the previous year to find out the trend and variation. Sometimes we compare budget with actual result to determine whether there is adverse variance or favorable variance, so that will influence our decision on the next audit strategy to adopt. That is analytical procedure. So analytical procedure usually considers comparison and relationship. So as I said, it deals with comparison, comparing a financial data with a non-financial data, or comparing two financial data in order to determine their trend and relationship. Now, analytical procedures can be used at the 3 stages of audit. Last time I said in audit we have 3 stages. We have the planning stage, we have the execution stage, and we have the reporting stage. At each of these stages, you can apply analytical procedures. So analytical procedures are used in planning the nature, timing, and extent of other audit procedures. So at the planning stage, analytical procedure is used to determine the scope or the extent of the audit. So for instance, if you compute your ratio at the planning stage, and let's say you have computed current ratio. I hope we all know current ratio. You computed current ratio. You considered your current asset as a ratio of your current liability. And then when you computed the current ratio, you had, let's say, 2022, 2021. Your current, you did some analytical procedure, and current ratio, let's say here was 1.5:1. Here you have, let's say here you have 0.5:1, and here you have 1.8:1. Now, somebody should explain this ratio to us. I mean, you are all writing public reports, so this one will refresh your memory. How will you explain this ratio to somebody? Comparing the 2 years. What is the implication of this ratio?
So for the year 2022, your current assets cover your liability by 1.8 times. And then for 2021, you can only cover half.
Okay. So what is the implication? What is the trend? Is it showing a positive sign or is it showing a negative sign? Why positive?
Because 2022 is more liquid than 2021.
So 2020, the company was liquid, right? Than 2021. Any other?
We can't really say it was more liquid because the current ratio includes inventory and then accounts receivable. So that could be the reason why 2022 is higher than 2021.
Okay, any other? So, as we all said, see, especially when you are analyzing ratio there, it will always come. So you need to know how it's analyzed. Don't be on one side. For instance, this ratio, as you said, you say that it means that the company is liquid. Yes, it's partly true. And what our sister also said is also true. Now, we know that current ratio means that our current assets over our current liability. So, the auditor has computed this, is undertaking this analytical procedure. What comes to mind is that in 2021, current assets, the company was having cash flow issues. Why? Because even the current assets were not enough to satisfy the current liabilities, isn't it? Now, there can be so many reasons attributed to this. Now, if you come to 2022, current asset was more than current liability by 1.8 times. Now, what it means that current asset is more. Now, you ask yourself, does it mean that the company is liquid? Not necessarily. Because unless we are able to know what makes up that current asset, there may be, as she said, there may be a lot of receivable, of receivable. There may not be even any bank balance or cash balance. The current asset may be attributed to inventory and receivable. There, especially the auditor is interested in receivable. If receivable has increased, or if receivable is the major figure determining this current ratio, then the auditor is interested as compared to last year. It means that we have made a lot of sales. However, we were not able to collect the sales. So the auditor will be interested in going through the receivable because it may not be so. It may be that it has been fictitiously cooked or something like that. So we are interested in those receivables. So in this situation, because of the trend, the auditor will want to find out from the records what actually caused the current ratio to increase in 2022 than 2021. This is made possible through analytical procedure. Sometimes we can compare budgets with actual, and the variance gives you an idea of any further audit procedure to undertake. Then, analytical procedure is also used as a substantive procedure for testing of transaction and balances. So, we can also use it at the execution stage. Analytical procedure is used as a substantive procedure, and last week we explained what a substantive test is. Based on this, it can give us an idea to probe more into the vouchers, into the transactions that has actually happened. And then it can also be used at the overall review stage to allow the auditor to conclude whether the financial statements are consistent with knowledge of the business. So, analytical procedure can be used at the planning stage. It can be used during the execution stage as a substantive procedure. And then it can also be used at the overall review stage of the audit. Last week we went through the assertions, so we will not go there. Now let's talk about using the work of management experts. Now, sometimes, just like the auditor, in the course of his work, the auditor can also rely on the work of an expert. Sometimes, management also rely on the work of an expert. Now, if an expert has been employed by management to assist management in undertaking some transaction, or if an expert has been employed by management to assist the organization in certain area or certain areas of the organization, during the course of the audit, the auditor will want to assess the work that has been done by the expert. Now, the auditor takes certain things into consideration in assessing the work of management expert. One, the auditor wants to find out whether the expert has any financial interest in the entity. Why would the auditor find out? Or why would the auditor be interested in finding out whether that expert, which has been employed by management, whether that expert has any financial interest? Because what the expert has done, it has influence on the auditor. Now, if you have any financial interest, we went through code of ethics. We talk about that. When you receive some gift, if you have any shares, it can affect your objectivity or independence. So the auditor is interested in finding out whether the management expert has any financial interest in the client. Two, the auditor will also be interested in finding out whether the fee paid for the expert services is reasonable and reflects commercial price. So the fee that has been paid by management to the expert, the auditor will be interested in finding out whether that fee reflects commercial transaction, which technically we call the arm's length transaction. So that price, will other people charge for that same services? Is it artificially low, or does it conform to commercial terms? The auditor wants to know that. And then the auditor will also want to find out whether the expert has a personal relationship with a senior manager in the audit. The auditor wants to find out. Again, before the auditor can also place any form of reliance on the work of management experts, the auditor considers the following. One, the auditor reviews the terms of the engagement, such as the objective and scope of the expert work. So before the auditor can also place any reliance on the work of management experts, the auditor also wants to consider the terms of the engagement. How was the expert engaged? What were the terms? The terms of engagement. What was the scope of the work assigned to the expert? And what was the extent of work to be done by the expert? Two, the auditor also considered the content of the expert report and the conclusion that the expert reached. So the auditor will be interested in knowing the extent of the expert's report. The report that the expert has provided, we want to know how extensive is it? What is actually the content of that report before we can place any reliance on the report. The auditor also considers the method used by the experts. For instance, maybe the expert made some form of evaluations. The auditor will be interested in knowing whether that method of evaluation is consistent with the IAS or IFRS. Four, the auditor also considers whether the date of valuation, the date that asset, let's say an expert has been employed, let's say that currently in the government sector, the schools and the assemblies, they are moving to full accruals. Whether they like it or not, they are moving to full accruals. Some have even started, especially the assemblies. Now the schools are now doing warm-up to move to full accruals. And during this stage, so many things happen. You need to value your buildings, because this is the first time they are even going to do accruals. So you need to do valuation. And in doing the evaluation, you need somebody, engineers and people who have experience in that. They are the experts. Now, when they do the evaluation, and you don't do the evaluation close to the end of the year, there is a problem. Why can that create a problem? Valuation should be done getting to the end of the year, not even at the beginning of the year. Why is it so?
Maybe at the beginning of the year to the end of the year, the value might have changed because the difference in the month is very high.
Yes. That is the main reason why it's mostly not advisable to do valuation from the beginning of the year. Mostly when the year is ending, that is where we prepare the financial statement. And you see, when you do valuation getting to the end of the year, at least it can give you a proper estimate of the values. Valuation doesn't mean accuracy. So even when you do valuation, the figures we see there, it doesn't mean it's not correct. However, I mean, it's close to the real figures. So mostly valuation should be done at the getting to the end of the year. So if there is any valuation that has been done, the auditor will want to make sure when was the valuation made. Was it made at the beginning of the year or it was made close to the end of the year? The auditor wants to know that the valuation was being done close to the end of the year. Now, we have already explained what constitutes sufficient and appropriate audit evidence. Now, let's look at factors that influence sufficiency of audit evidence. Audit evidence. And last time we said that sufficiency is the measure of what? The quantity of audit evidence in numerical terms. And appropriateness, we are looking at the quality of audit evidence. Now, we want to look at the factors that influence the quantity or the sufficiency of audit evidence. Factors that can influence the quantity or the sufficiency of audit evidence. One, we look at materiality of the item. So materiality of the item that is being tested is one of the factors that will determine the sufficiency of audit evidence. Then we also consider the audit risk. The audit risk involved. It also has impact on the audit evidence. Then, the financial position of the client. The financial position of the client also has influence on the sufficiency of audit evidence. Then, the nature of the accounting and internal control system. The nature of the accounting and internal control system can also influence the sufficiency of audit evidence. Additionally, how persuasive the audit evidence is. So persuasiveness of the audit evidence can also influence that. And then the population of the item. The population of the item. So persuasiveness and then the population. Of the items. These can all have influence on the quantity of the audit evidence. Now, we also explained that appropriateness means that audit evidence is reliable. We talk about the quality of audit evidence. And when we say appropriateness, it talks about the quality of audit evidence. And that talks about relevance and reliability. Last time we explained that. Now, what will make audit evidence reliable? what will cause you, assuming that you are an auditor, what will cause you to rely on an audit evidence? What are the things that you will consider in order to rely on an audit evidence? So here we are saying that, well, audit evidence is more reliable when it is obtained from independent sources outside the entity. So before we can place some reliance on an audit evidence, when that evidence